Okay, class, today we're going to talk about long-term assets a little bit further. We know last time we covered 3 basic depreciation methods. This time we're going to talk about acquisitions when you buy more than one asset class in one lump sum. We'll give you several examples. We'll let you work on a couple of those, and we will actually do a little homework preview for you. And next time we're going to talk about revising depreciation during the life of an asset and some disposals when you get rid of an asset. Okay, first of all, let's talk about these lump sum acquisitions. Suppose a local developer want to buy an apartment complex. It's not just going to be the land that it sits on. He's going to acquire several buildings, probably includes a parking lot, and let's say there's a lot of equipment to be included in the purchase. So these are actually four different asset classes: land, building, parking lot, and equipment. First of all, we want to know, how would you properly record this transaction? And second of all, which of these are depreciable? Well, let's change the order of those questions. What's depreciable? Land is not depreciable. The others are. So this is critical. That's why you have to record it separately, because you want to depreciate what you can. That helps your taxes. That is the right way to do it in accrual accounting. So therefore, we want to find out what breakdown of the total purchase falls into each category, each asset class. So we have to do it this way. Okay. They may have different lives as well. Building may last longer than parking lot. Equipment depends on the equipment. Okay. So first of all, how to record the value of these on the books? Well, we have to allocate the individual costs proportionally to their relative value. How do we do that? Well, IRS says that we have to figure out the basis of each asset by multiplying the lump sum purchase by a fraction. Well, how do we get that fraction? We have to take the FMV, the fair market value, and that is usually given to you in the problem. But typically in the real world, that is given through an appraisal or some other valuation method. Okay, so you can see the IRS section there, but this is how it's done. So let's do an example. Okay, in this specific purchase, how are we going to find that fair market value? Well, this is how the IRS defines it. It's got to be reasonable, where willing seller, willing buyer, neither one is under duress where they have to buy or sell, and everybody has reasonable facts to go behind the purchase. So usually this is done by comps. If you're involved in real estate at all, you know that's how they appraise properties. They look at comparative properties in the area, hopefully recently, of similar square footage, similar property type, and all that. And typically those appraisals will give you the fractions that you need, or the percentages that you need. Okay. This would be given to you in the problem. The appraised value of each asset fell out like this, and that totals $5 million. Now remember, the purchase price I think was only $4 million, right? If we go back, wasn't it just $4 million? I think it was right here, $4 million. So we got to be careful about that. Want to make sure that the appraised value is not the same as the purchase price. If you buy things in lump sum, multiple asset classes, one large deal, you typically get a deal. You typically get a good price. Okay, so keep that in mind. So what would our journal entry look like? Here's what we would do, right? Just take the appraised values, cash $5 million, but wait, we didn't pay $5 million. You can't record things on the books if you didn't pay that much for them. It doesn't matter what the appraised price is, it's what you paid for it. Okay, in most cases. There are some exceptions, we'll talk about that later, but here we can't do that. You have to record it according to the actual price. Okay, so 2 steps. Find the percent of the total appraised value for each asset class. Okay, so we would do that like this, and this is where I would use a spreadsheet. The appraisals came in at 2.5 mil, 1.5 mil, 500,000 each for the parking lot and equipment. And if I add them up, it comes up to 5 million. I divide each number by 5 million. 2.5 million here divided by 5 million is half, 50%. 1.5 mil divided by 5 million, well, that's 30% if you do the math. And again, spreadsheets are very, very helpful with this. Parking lot, $500,000 divided by 5 million, that's 10%. You can see, right? 5 divided by 5, you're going to get 10, and this one's the same, 10. These have to add up to 100%, obviously, and they do. 50, 30, 10, 10. There you go, 100%. Now, what do you do next? Well, you multiply these percentages here by the total purchase price, because the total purchase price is not the same as 5 million. So here's how we do that. Just go 50% times 4 million. Half of that is 2 million. There you go. 30%, 4 million. 1.2 million. 10%, just take away a 0, you get 400,000 for each of these two, the parking lot and the equipment. Of course, these have to add up to 4 million. Check your math, and they do. 2 mil, 1.2 plus 0.8 mil for these two combined. There you go, 4 million. It adds up. And again, the spreadsheet's very valuable for this. Okay, so even though the appraiser said 5 million, with these breakdowns, with each line item, with each asset class, you can only put on the books what you actually paid for it. So this is how we're going to do it. All right, what's that look like? Here's a visual look at that. Here's a big pie, the appraised pie, broken down by percentage. Notice the slice of each respective pie is the same in proportion, but obviously this pie here, the allocated cost is smaller because you got a great deal. This pie totals 4 million. This pie totals 5 million. Makes sense, doesn't it? But notice the proportion of the pies, right? The land in blue is still half the pie. This one here, the building, is still, I think, 30% of the pie, almost a third. Okay, and these two make up 20% or a fifth of the pie if you combine the green and the red. But notice they're proportional, and it's just a smaller pie because the actual purchase price is smaller, which is almost always the case in a lump sum deal involving multiple asset classes. Okay, now it's your turn. Here's a problem. Facebook's going to open a new office here in the area, and they're going to buy the old Roseville Gateway campus for $8 million. Realtors had the property and everything assessed, or appraised rather, and so this is what the appraisals came out to, and it's your job to figure out the appropriate cost that should be recorded in the company's books for each asset class. Okay, I'm going to give you a few minutes to work on that. I want you to pause this video and try to work that out and then look at the solution. Okay, so pause the video, come back when you're done working. Okay, should be back. Now here's your solution. Find the appraised values. Do the math. 5 million divided by the total was 10 mil. Okay, if you add these up here, these actually add up to 10 million. 5, 3, and 2, 10 million. So you divide by 10. Okay, so that's 50%. Building, 3 million divided by 10, 30%. Equipment, 2 million divided by 10%, 20. I made the numbers very easy for you. Of course, these have to add up to 100 right here, and they do. Okay, and now what you got to do is step 2. Multiply the percentages times the actual price they paid, 8 million, and you'll get the cost allocations. 50% times 8 is 4, 30% is 2.4, 20% is 1.6. These add up to 8 million. There you go. Straightforward. Now I've given you easy numbers. Okay, you're going to get a problem on a worksheet here in a minute where the numbers aren't quite so easy, and you'll have some problems in your homework that aren't quite so straightforward. But if you do the math properly, you will get the same answers, or you'll get good answers here for all these. Okay, notice this equals the purchase price, and there you go. Now here's an example of why this is important. Okay, here is a property tax bill from a income property for an investor. Notice here I've blocked out all the personal information, the parcel and everything, but right here, notice right there, the land and structural improvements, that's the building, right? You can depreciate the building, you cannot depreciate land. So this breakdown really determines how much the owner can depreciate, and that is a tax deductible expense. So if this number were higher, notice it's only 63,600. If that number were higher, he would have more building he could depreciate. He'd be able to take more deductions off his taxes. He would save more money on his taxes if the building were worth more than the land. Okay, so these percentages are critical. The county comes out and assesses the property. It's not really an appraisal, it's an assessment, but these are, here's a real world example of why this matters. Okay, so to wrap things up, here's what we're going to do. I'm going to give you a worksheet right here that has several problems involving yesterday's or last class's content on 3 types of depreciation. You're going to complete this worksheet. It also has at least one problem on allocating costs for a lump sum purchase with different asset classes. There's answers on the bottom of the back page. You're going to do your week 6 homework on the Connect site as usual. You get 3 attempts, 20 points this week. And there's actually a video of this one. I'll post the URL later here, but this video is going to actually help walk you through these problems in case you want to refer back and see how it's done. Okay, there's other resources too. There's other textbooks out there. Here's another video from, I think, Utah State University. So there's all kinds of resources for you there if you need help with this. All right, hope that helps. We wish you luck with all this, and hope that's a easy to follow concept for you.